Welcome everyone to our new speaker series. We have with us today Peggy Fasano and Adam Markley with PROX Search Capital. And these guys are here to chat about how they co-invest with searchers. I do want to preface that these guys at this time are only investing in US deals. So for the Canadians on the call, we do have a blend of a Canadian American audience today. For the Canadians, we are keeping an eye on which funds do invest in Canada. So lots to learn from the session today, no matter where you're based. And we'll go through a couple slides on Village, and then we'll give the floor to these guys and jump in. If you are new to learning about Village Wealth, we are a deal managed platform that was built for buyers. We are where you can begin and launch your search, access opportunities. You can track all of your activity as you manage which deals are at which stage in the process and which brokers you've talked to, and keep track of all of your activity, and also share a dashboard with anyone else on your buying team. We have AI tools built in that can help you evaluate and do your financial modeling. So with over 40,000 listings in our marketplace, customized deal management dashboard for each of you, an AI analysis, deal structure, and financing calculators built in. It's a tool that trains you on acquisitions as you use it. We partner with ETA accelerators and incubators, as well as ETA communities, lenders, brokers, and M&A advisors. So if you fall into any one of these categories and you'd like to chat with us, please don't be shy and you can get in touch with us. We are starting to run more of these sessions on a regular basis. So our next sessions have Christian Montaigne, who is with Vantage Advisory, sorry, and he's going to be chatting about the seller psychology. Oh, this happened last time as well. Bear with me, I'm just going to stop sharing my screen for a moment. And I will represent in a moment.
You have to tell us how you did that. That was really cool.
I wish I knew. Bear with me. If anyone else knows, please let me know. Okay, can you guys see this now? Is it covered in red?
All
Okay,
good.
thanks, Eamon. Okay, so February 20th, we have Christian joining us. February 27th, we have Zafar Jaffer with Gowlings. He is a M&A lawyer, and he's going to be chatting on offers, negotiations, and closing the deal. So please join us there. You can scan the QR code to register for these upcoming sessions. And for anyone new to us who has not explored our platform, we have a 2-week free trial that we're offering on our premium subscription. So with our premium subscription, you get full marketplace access to all the deals, notifications of new deals on a daily basis. We do weekly open office hours for those who just have questions, and you get full access to the deal management software. So you can scan that QR code and check things out. Little bit of housekeeping today. We will I'll let Peggy and Adam introduce themselves momentarily. Feel free to post in the chat where you're tuning in from. We love to hear where people are tuning in from. If you're a buyer or a seller or an advisor, please don't be shy. Peggy and Adam have created a short presentation. Please put your questions in the chat. We'll be monitoring the chat. They're going to run through their presentation first. It's only going to be about 10 or 15 minutes, and then we can jump into the questions. Okay? So that's my last bit. I will stop sharing and pass it to you, Peggy.
Awesome. All right, can you guys see my screen?
Yes.
Perfect.
We also see all the edges as well. There we go.
Good. Okay, great. Well, it's awesome to be here with you guys. Excited to be chatting everything about search with you. So Both Adam and I are from PROX Search Capital. We are an investment fund that is focused primarily on helping self-funded searchers get good deals done. So we provide capital at closing so that you can, one, get a good business, and two, maybe look at a bigger business than you were originally thinking about. So we'll do quick introductions for ourselves. I'm Peggy, obviously, managing director here at PROX Search Capital. I come from a engineering and business background, so I've got a lot of background on the operations side. I've managed and grown a 20-person company myself. Was a engineering and manufacturing firm. I bought a business 4 years ago with my husband and I that is a little bit of a long story, but that business was a sales call center. We had to pivot. It's now a tech AI company. So I've been there, done that, and I will let Adam do a quick introduction on himself.
Yeah, perfect. Along the vein of being there and doing that, acquired and built out a holdco over the last decade. For those in the US, several of those deals were with SBA loans, where I was the signator on that. I've done on-market, off-market deals, bank deals, and non-bank deals. I used to be in the education space before it blew up, and now teach it, I would say, more legitimately at the University of Colorado. Um, and yeah, we run some pretty big communities. One here in Colorado where we live, and then I've got a second one on the East Coast where I have a footprint and several of my companies. But yeah, we work really hard to try to enable and encourage those to structure deals for success. It's all about maximizing that post acquisition. The hard part of search is not buying the company. It's what happens thereafter, and so it's a big part of our experience and how we look at things.
Awesome. So how do we work? So we're an investment fund for self-funded searchers. We partner with you to look at, your deals as you're going through them. So Liz and we were all just talking about this beforehand, and one of the biggest questions we get is, when do we get involved with you through your search journey? And for us, we like to be involved earlier rather than later. So we like to be involved where if you've got a really good deal you're excited about, you might want to put an LOI in. That's the moment that we can really be helpful. We're always excited to partner with people who are more operators and not M&A transaction experts. Like, the whole point is for you to be successful after the deal, not on the deal itself. So that's where we kind of can really create some value add for you of helping you through that process of crafting the LOI, structuring the deal, doing the due diligence. Like, we would be there for advice and support. So that's kind of where we sit on the pre-acquisition side. For post-acquisition, we are a advisor, a mentor for you afterwards. You are the one that is going to be running the business day to day. You are making all the decisions. We're there to advise and support for you. And for our deal economics, we are very aligned on long-term success of the business, not short-term control. So like I already said, we're focused on you being able to run that business, really be owner of that business. And so on a high level, what do we look for in an investment? We're looking business size, 500,000 to 2.5 million in adjusted EBITDA. Our industry, we're pretty agnostic, although we are just US based, like Liz said. Our investment size, so we write $200,000 to $800,000 checks, and the most of the time we're looking for an ownership target of 5 to 20% based on the company size and the type of deal and things like that. Who do we back? So who do we like to work with in terms of searchers? Now, we've got kind of a long laundry list, but I am going to start with our top two things. Is we like working with people that are a little bit more mid-career. It's really important for us that they've got leadership, management experience, You have experience running a budget or a P&L. You've got those operations experience. And then when we talk about transferable skills, that's also important to have some type of industry experience that in the industry that you're looking at, or some experience that would translate really well from one industry to another. So we've got one searcher who had a background in home services, selling and working for a company that did siding and windows, and they ended up buying a roofing company. So not the same, but it's very similar. It would be hard to see someone who maybe comes from a I don't know, a banking background and wants to buy a fabrication metal shop. That might be a little harder to see those transferable skills there. Um, Interpersonal skills, we also really like to see folks with great communication skills, good thought process, being able to negotiate and deal with rejection and really be honest and transparent. And some of the reason we like to be involved through the search process is so that we can see you and see all of your skills through the search process. And so we can make sure that one, you're going to be able to operate the business afterwards and work with the employees and all of that. Other things that we look for, so a personal balance sheet, we do want to make sure you have some liquidity. It's important for the company that you have somewhat, I mean, if you've got a really, really rainy day and you've got to make payroll, sometimes you do end up pulling out of that personal balance sheet. So just want to mention that too. So how to stand out. So I kind of mentioned some of this before, but when we're working with a searcher, how do you really stand out as someone that we're really excited to work with? Um, Cannot emphasize enough EQ over IQ. It's so important when you're running a small business that you can work with the employees and work with all those clients. And so having the correct demeanor and disposition where you can talk with lots of different types of people is really important. Communication, cannot emphasize this enough. It is really important to be able to communicate, not just with employees and things like that, but also with potential investors that you've got and all of your other vendors, clients, etc. The other big thing that I like to mention is just self-awareness. When you come into a small business, there's employees that have been there for a lot longer than you, and being able to be humble and come in and learn from others is really important. In being able to run a small business and be able to have a successful transfer. Um, Quick red flags for us: no management experience, no experience with a budget or P&L. We really want to see you motivated for ETA and going out and buying a business. And then the other big thing is kind of unrealistic deal and growth expectations once you dive into a deal a little bit more. So at this point, I'm going to hand it over to Adam to talk about the business and what we look for in those businesses.
Yeah, perfect. Thanks, Peggy. I think just to reiterate before I jump into this, it's like that ego and humility is where relationships fall apart, and we've seen that constantly, right? The biggest likelihood of success is maintaining a great relationship with your seller, and if you let your pride and ego get in the way of that, it can be really detrimental. And so when we're actually then looking at the underlying business, what's important to us? We want to make sure it's a profitable business, has been a profitable business. The gold standard is recurring or reoccurring revenue. The seller's actually got a reason to exit, customer retention's high, and there's opportunities to create value and growth. But let's be clear, that doesn't mean just get rid of the fax machine and the business will just grow. Those tales of success are far-fetched to say the least. Growth is expensive, it's hard, and takes a lot of work, but you're identifying those strategic opportunities that you can create value. It's never just throw marketing at it and it'll be fine. We want to see stable and growing industries. We've looked at businesses before where the overall industry is declining, and you might have a stalwart or a standout in those space. We're typically going to pass, right? It's hard to fight macro level conditions when it's something that is so severe and contracting. And so it just makes it harder to be investable. We don't like unstable, declining revenue. Listen, we're far enough past the impact of the pandemic and what that looks like. However, there can still be tails to that we've seen in 22, 23, 24, 25, and depending on the cycles in the industry where that things come through. And so really understanding that. But if the business is falling, do you know if you're catching at the bottom or are you buying into something that's really collapsing? Momentum is incredibly important in a business. It's similar to inertia in physics, and you want to be very cognizant. If the business is in a downward motion, it's really hard to turn around unless you're incredibly well capitalized. And typically, debt is not a great place to start with that. Asset-heavy businesses, we tend not to like those. We can get behind them, but it's going to depend on the nature of the assets. If you're a manufacturer that's just got one $3 million piece of equipment, that can be really hard versus, say, a trucking company that's got 30 pieces of $100,000 equipment. So what's your revolve? What's your capacity to turn that over? And then conversely, are you buying as a multiple of cash flow or is it just earnings or adjusted earnings? Because you've got to have a level of maintenance capex in those businesses. Customer concentration is a death knell for most. People tend to reduce and prevent a realistic understanding of the impact of customer concentration. If you have a customer, for example, that is 20% of your revenue, if they go away, your earnings don't drop by 20%. You typically can lose 100% of the profitability or more, even with one customer because your fixed overheads and variable costs and how they work together. And when you buy a business with leverage, you can absolutely destroy that because you're adding a huge fixed charge. I joke around when you buy a company that the two things that you have to do, pay your debt and pay your taxes, and both of those will kill you otherwise, and that risk is cannot be understated. Um, and then it's relationships by the sellers. You got to be so careful that they're not walking out with all of those relationships. It's hard to transition. Other than that, we can be agnostic, but seasonal industries are hard to get behind, commodity exposure and things like that. A business that does 80% of the revenue in 5 months is going to be really hard because when you add again leverage to that business, your debt payment exists every month and you create a real cash flow problem of how are you bridging that period. So it's something we are very cognizant of and aren't really big fans of. So what about you? What are things we're looking at there as well, and how do we think about analyzing that in with the deal? We want to make sure first and foremost you're a good fit for the business, right? Do you have transferable skills that are going to align with the business you're looking to acquire? If you spent your entire life pouring concrete and you come and say, "Hey, I'm going to buy a tax accounting firm," that's probably not the linear fit that most investors are going to be comfortable with. This isn't something you have to be passionate about per se, but you've got to be insatiably curious at the end of the day. The best entrepreneurs in the world never stop learning about the business they're running, both what's happening internally and what happens outside of it. And you've got to be able to have that interest. And then again, is it a long-term fit for your goals and your desires? You know, as we're thinking of the deal, we're going to go through the risk. We're going to assess it. We're going to run our own financial models around the business, our upside, downside, base case scenarios. What are the concentration issues? How are you going to fill the owner's role and optimize to that? It's all very important to recognize what are the strengths and weaknesses of that deal and fundamentally, and how do you mesh into that? Certainly, from a financial perspective, we're going to make sure that you can pay for the business. The number of times I've seen someone say, "Hey, I'm going to buy this company," and the business can't even support the debt, let alone any of the other acquisition elements. I would presume most of you guys on this call are going to be much more sophisticated than that, but you can miss things, right? Was working with a searcher who found a great business doing 1.5 million of earnings, but just didn't calculate the equipment replacement cost correctly, and all of a sudden couldn't pay for the business at the desired purchase price. What are the real earnings of the business? If you're working with a business broker or other intermediary, they're incentivized to help the seller increase the purchase price by doing add backs or other adjustments. Is that adjusted earnings validated? Make sure you get a quality of earnings to actually truly understand what the real cash flows and financial capacity of the company are. And then understand in your base case, um, this isn't again just slap marketing on and this thing will fly to the moon. We want to see very low double-digit growth. We want to understand what the J curve, if you don't know what the J curve is, quickly, typically in the first 12 months post-acquisition, either revenue dips or your cost expand, and therefore the overall margin of the company compresses and you still have a leverage company that you've got to pay the debt on. So navigating that's important. When you're planning an exit, I'm going to take this company from a 4x to a 6x, 50% expansion, life's good. Yes, most investors are never going to underwrite to that. That's just not the type of business you're growing and running. And make sure that your costs expand accordingly with inflation and your desired growth. If you're going to grow and make a case to increase revenue by 10% a year, but none of the costs adjust in the same fashion, that's a hard model to buy, right? At the end of the day, growth costs money, and you're going to be making investments to drive that growth and have to reflect that accordingly. And then finally here, what are the things to maximize your success? Optimize for operating with liquidity. This is probably the number one thing we push on in the deal itself. We joke most deals shouldn't be funded at 100%. They should be funded at 110 or 120%. What does that mean? You're taking extra cash in and you're putting it on the balance sheet. That cash gives you downside protection, so your personal balance sheet isn't as risk. That cash gives you investable opportunities for growth. And then that cash allows you to make strategic decisions in the business without the constraint of saying, I need an ROI in that investment today or tomorrow. You can have a long-term focus, right? A couple anecdotes. I've seen people raise an extra $1 million on a $3.5 million deal just to put the cash on the balance sheet for growth. And then there's one searcher we saw, he prepaid his debt for the entire first year. That was the wildest and coolest way to jump into that first year of operating. He could run the company as if it's debt free and make the decisions needed to navigate that transition without the risk of a debt payment. Um, so be a good communicator. Peggy's already talked about that. Yeah, be able to walk in this company at any point and know that you can create value and impact. And then finally, have a clear and credible investment thesis. If your investment thesis sounds like I'm just going to buy a company that's making between 750K and 1.5 million a year, industry agnostic, that's not a really great investment thesis because a concrete company, a CPA firm, any other, like they're not the same. And even though they might fit your buy box from a financial perspective, doesn't mean you're qualified. Be very specific around what makes sense, and then be action oriented. This bias for action is so important. If you don't demonstrate it and have it here prior to closing, well, when your butt's on the line, it's going to be even more important. So just be capable. Stop worrying about how to track things and how to monitor things, to the nth degree. Just go do. Uh, be pursuit of that. And you guys can see the screen. Nothing unusual here. Overpaying and over leveraging is the quickest way to create problems. Overestimating what you're great at, therefore underestimating the skills gaps is punitive. Um, the cultural fit's important. This is the EQ we talked about. Remember, the day you buy a company, 100% of the employees know more about that particular business than you do. And that's where that humility comes in. Uh, don't underestimate the non-P&L elements. So this is CapEx and working capital. Choose a business. Do not choose one with high seller dependence. And please stop playing business and focus only on the financials. You have to get comfortable being out in the business, understand what it takes. I like to say you should be the seller, a first and last resort of that business or salesperson. You should know how everyone in that company can sell the product or service you're buying and be capable of doing so. When things go sideways, you will be relied upon to do that. No one else is going to care more about your money than you, and so they're not going to step up in those moments, and you have to be capable of doing it. So that's what we look for, and that's how you can maximize your success. We tried to whip through this pretty quickly so we could get to Q&A, and so we're here to answer any questions you've got. What it looks like to do deals, what does investment look like in the space, and basically any other topic in between. We're happy to participate.
Thanks so much, guys. We really appreciate that. It's a pretty thorough run through. We still have lots of room for questions, and I realized I forgot to introduce myself. So if anyone's new to any of our sessions with Village, my name's Liz McRae. I'm a co-founder of Village Wealth. I am curious what spurred you guys to start this fund? Like was there a triggering event or what, like why did you start Prox in the first place?
Yeah, great question. So, after having been a primary acquirer for a long time, in my holdco, we started transitioning to look at minority investments as opposed to can only operate and sign so many personal guarantees. Um, from there, started finding opportunities to invest, and then ultimately met Peggy and others, and the idea was this will just help write more checks larger on a more frequent basis for what we're already doing. We have great experience, and it just allows us to create more of an impact while also, transparently generating a great financial return. But the real impact is an extension of what we've done already, which is acquire, operate, and fail a lot along the way. So I always joke we've kicked a lot of the door jams and can help you avoid some of those kicks. Can't prevent them all, but there's certainly ways that we can help with that. So
Fantastic. Thanks. Anything to add there, Peggy?
No, we can just jump on to the next one. Just doing good deals. That's our goal.
yeah.
Good goal. Well, someone started us off in the chat there. Thanks very much. So the rest of the session here, guys, is your time to ask your questions. I will fill the space if there's any pauses, but this is your time. So, Adam, Peggy, you've got eyes on the chat too.
Yeah, so
Question?
Brennan, your
Yeah.
question, where would Prox sit on the capital stack and preferences we would have on the exit? Would we also PG the loans if the operator isn't fully approved by the SBA? The answer is no. We're not going to personally guarantee the loans. What's one thing that's important to us is like we'd never ask you to PG one we're not comfortable with, and what we mean by that is simply that we don't think it's a good deal and you shouldn't do it. Um, but no, typically speaking, if you're not capable of personally guaranteeing a loan, we should all back up a few steps in the acquisition process anyways and understand why you're not capable of personally guarantee it and what banks or lenders are saying that isn't interesting for them regarding your personal financial situation. Most of the cases, the real solution to that is you don't have a strong enough balance sheet. That's not solvable unless you bring on a partner or you're not the right fit for the business. Most of the time, that means it's probably a deal we're not investing in anyways. But in the case we liked you and then we liked the business, then we would probably work with you to try to figure out who could be a partner, who'd be a partner for you on that. That's the second part. So coming to the capital stack. So we are equity providers. We are not debt providers. So the way the capital stack works, and we'll use an SBA loan for the starting point here, is the SBA loan is a senior debt. So they're going to sit above everybody in the capital stack. If you have a seller note, that's going to be subordinated to that. So that means it'll be the SBA, then the seller note. So your debt is always above of equity. Then you get to preferred equity, and that's where we sit. So we're preferred equity. What that typically looks like is we'll receive a preferred rate of return on our investment. And then from there, once we get our original capital back, whatever your ownership and our ownership is, all cash flows from there on out are pro rata. So in the case of an SBA deal, if we're a 20% owner and you're an 80% owner, once we get our original investment back, every dollar thereafter that comes out of the company, whether it's operational or it's on exit, would be split 80/20. The only cash flows that sit outside of this waterfall, right? Again, debt is always first, right? Debt and taxes, you got to pay those. So debt, lenders get paid. taxes are always paid pro rata to ownership. They don't really count for the classic pay back your preferred. So if there's taxable income, everyone's got to be responsible for the tax bills if it's not paid at the company level. And in that case, you would receive 80% of those cash flows in this example.
Got it. Thank you. I have a follow-up on that real quick. So
Yeah, by all means, yeah.
the SBA, when they're looking at balance sheet health, I have a lot of real estate and I'm leveraged on some apartments.
Yep.
Are they going to look at that from a personal perspective, or is that more business related?
So they're going to look at that leverage, and if those properties are self-sustaining, you're going to be fine. What they will look at is if you're sitting on a good chunk of equity in those properties.
Hmm.
SBA rules dictate any property you own that you have 25% equity or more in, they're going to attach as a subordinated lender to those properties. So they'll come in a second position on those properties, only up to whatever the gap is on the SBA loan. So for example, if you do a $5 million loan, the federal guarantee is 75%. So 25% is 1.25 million. They're going to attach to equity up to that amount for real estate. So if you had five properties that would still be less than out on the equity, but they achieve that 25%
Hmm.
equity value, they would file a second lien against all of them.
Got it. Okay.
Yep. Yeah, so they tend to like borrowers who have collateral. So if
Yeah.
you're in that situation, provided the underlying investments are cash flowing and positive and they're not at risk in that way, then yeah, that would actually lend towards a more qualified borrower.
Okay.
Because real estate is real collateral. And even if they're subordinated to your primary lender, meaning they can't trigger a sale of that property or foreclosure,
Hmm.
it does mean at some point when that property trades hands, they could get their money back, whether you try to refi or sell.
Okay. Thank you.
Yeah, you bet.
Great
So the
question.
next question is, do you guys assume and account for sweat equity as part of your partnerships with searchers and operators? And the question that is like kind of in the sense that you are going to be the one going out and getting debt financing. And so your percentage of ownership is based off of that debt financing plus the equity financing that you're bringing into it. So like Adam kind of alluded to, most of the time you're going to be looking at a 80% ownership of that company, and we would come in for 20%. Someone else had a question about step up, so I can kind of jump in and also include that here of what that means. So we would, let's say we come in and provide 10% of the cash required for the actual acquisition. That 10% cash would turn into 20% equity with a 2x step up. So at the end of the day, if all you needed from us was 10% cash, it would be a 2x step up. We would get 20% equity. You would own 80% of the company. I think part of the step up multiple typical or the range, usually we're looking at somewhere between like 1.5 to 2.5x for our step up.
Perfect. So, yeah, so do we have any industries that you tend to back more than others? Do we have any that we stay away from? This is a pretty common question. Um, we tend to stay away from things that are highly cyclical. We kind of talked about that. So something that's oil and gas or heavy equipment manufacturing. Um, and so, yeah, it's those are typically what we're going to stay away from. But remember, we're really caring about what your experience is versus the business. Like those two in combination are far more important. Listen, if someone came to me and they're like, "Hey, I spent 20 years in construction, everywhere from a laborer all the way to the superintendent, and I'm working at a general contractor." Most people don't love construction, but you're a great buyer to go find a business for that space. You just got to make sure you understand the working capital and all the other challenges that industry has. But provided that's in line, then yeah, investors can get behind that if it even if it's slightly outside kind of the sweet spot of business. Um, Um, do we have any industries we tend to back more? I don't know if it's tend to. Um, Listen, it's some of the classics that a lot of searchers are chasing, right? Home services because of recurring or reoccurring revenue, business services or professional services, we see good a bit of those. Um, Things that are non-discretionary, whether it's logistics, logistics adjacent, or other kind of services, those are all great businesses. Um, um, that people go. You'll hear online all about boring businesses and stuff like that. The reality is no business is actually boring. They're all challenging and difficult in their own ways. It's just whether or not you're a great fit for it that makes the most sense. Um, all right, so can we share more on the importance of working capital, the 110% of value and options and approach for doing this? Yeah, so Peggy kind of talked through what a step up looks like. So you just apply the same thing. So for example, if you're going to raise 20% of cash on a deal, because you're going to put extra cash on the balance sheet. At a 2x step up, that means you're going to own 60% of the company and investors would own 40% if they're putting that capital in. Um, and I just gave a talk earlier this week on this specifically. And the reality is it's better to own 60, 80% of something than 100% of nothing, right? The risk in this game are very significant, especially with personal guaranteed debt. A lot of people don't realize that acquiring a company at the end of the day is no different than a little bit of going to Vegas, which sounds crazy. It's all about probabilities, and your job as a searcher is to increase your probabilistic likelihood of success, right? So if you're really great at counting cards, the reason you get thrown out of a casino is because you're changing the odds in your favor to the disadvantage of the house. Well, when it comes to business acquisition, there's no house to throw you out of. No casino is throwing you out for stacking the deck in your favor. But the same approach applies. What are you doing to increase that likelihood of success? Um, because that cash is both downside and upside. When you have extra cash and you're investing that in a manner that you get a positive rate of return, that rate of return is new earnings to the business, which is accretive to value. So it increases the overall value of the company and increases cash flow, both of which give you downside protection and optionality. If you end up 3 years into your business ownership, because you capitalized well in the beginning, you invested accordingly, and you added a few $100,000 a year to your earnings. Well, if you paid 4x at the beginning and you sold for 4x, well, you've added 7 figures of value to the business, which means if you're ready to get out, you can get out and probably walk away somewhat whole. Brennan was asking about real estate. The big difference between business and real estate is the hard asset of property allows you to escape with minimum damage. You just price 5-10% below market, you're able to liquidate that property in a reasonable-ish level of time. When a business goes down or things go sideways, there's no underlying physical asset. And because of that, it's hard to liquidate if things aren't performing. And so by facilitating growth through having good capitalization and being able to cover your debt in a slow time allows you to just buy time and buy opportunity for success. Um, so that's how you would do it. The approach is just you willingly decide to take on more cash, take less ownership for more likelihood of success.
There was a question about kind of deal structure. Like if we're not a 20% owner, what would we typically invest? So I just want to walk through a little bit of the typical deal structure of what we talk about. So a deal, when I say a deal, we're talking about total project cost. So that's your purchase price, your transaction costs, the amount of cash that you need on the balance sheet. Of that total cost, we kind of recommend 70% of that is debt, 20% of that is seller note, which is also debt, and then 20% is cash that you're bringing, so equity to it. So when we talk about kind of like the how much we're bringing, we're helping with that bucket of 20% cash that you're bringing in. So I mentioned earlier in the presentation, we write 200 to $800,000 checks. Sometimes that's not enough to fill that equity gap that you need, that cash gap that you need. So there are other investors that would come onto the cap table to help fill that cash gap that you've got for that like remaining 20% that you're looking to fill. Hopefully that answered that question.
Yeah, let me just follow up with it with like, do most people come to you looking for the equity part of it? Are they looking for the partnership and the sort of safety measure, safety kind of backup, the guidance, et cetera? Where do most of your people kind of fall?
Most of them are looking for the equity support.
Yeah.
And then just by extension, because we've been in the space for so long, we'll probably recommend lenders if they need it, or attorneys or other advisors or things like that, just because we know or who we like or trust in those spaces. But by ex predominantly, it's they're looking for capital to facilitate the transaction. And based on what we see in the deal or otherwise, we'll recommend sometimes, one of the deals we have closing this month. Originally, the searcher was raising 1 million. We ultimately pushed them to raise 2 million, brought in other investors to help facilitate that. The deal was retraded or renegotiated through closing. So then the actual capital from investors pulled back to 1.5 million. And so we all shared the 25% drop of equity checks going out. And so it's a diversified cap table with multiple investors who tend to work well. And that's the thing is like when we like a deal and we're committing to a deal, if there's equity needs above and beyond what we're willing to commit from a capital perspective, it's pretty easy for us to send a message around and facilitate interest to other capital providers to get that taken care of.
And sorry, just one more thing. What about somebody who has, say, the equity, they can, put buy the business on their own, but wants sort of the kind
Yeah,
of
that's no
comfort
problem
of
at all.
having a yeah.
Yeah, no problem at all. So similar terms apply. It'll be based on how much of a partner you're looking for and what's meaningful enough for us to justify the investment. So we'd analyze the company the exact same way. Everything else would be the same. And then from there, if you're like, listen, I don't really need the capital, I'm comfortable paying, what's a minimum amount of position or equity for you guys to be on board that creates that valuable partnership? Yeah, that's absolutely something we do. So no issues there.
And there have been situations in the past where we've been working with a searcher, they're getting to almost close. There's a retrade that happens, and all of a sudden they go from needing 1 million in equity to 500K in equity, and they're like, we can finance this all ourselves. And then we're like, great, if you can finance it all yourselves and you've got, the amount of cash that you need and working capital, like go for it. There's no like contract that you've signed with us that says yes, like we have to invest in the company. Obviously, we'd be sad if we're not investing, but it's not an obligation.
Hopefully that answered your question there, Aaron.
Which one's next?
Alex, are there ever situations where we take common shares instead of preferred? What would motivate this? Um, Typically, no, just for the nature of the investments. Um, However, that's not to say it hasn't happened, right? It just looks a little different. We have one where we're common ownership, and it's not really preferred shares. It's more a preferred distribution scenario, so just a slightly different waterfall. But for the most part, no. There's other reasons why these share classes are set up this way, or member units if it's an LLC. A lot of it has to do with SBA loans. For example, you are the operator, you control things. You have a ton of protections as an operator, given the SBA rules. We can't fire you, we can't mandate things like that. And so the cleanliness of separate ownership groups actually highlights that in the rights in which are listed in the legal documents. But also it's a cash risk element. So in the scenario where we're putting in, capital, we part of the preferred return is creating incentives for us to get our money back and how it impacts the overall equity waterfall. If everyone's common, then everything's pro rata typically from the beginning, and that we would have to have a significantly larger equity stake for that to typically work out from a math perspective for the type of risk this investment is. Do we have a mandatory exit timeline? No. Typically, we're looking somewhere in the 10-year range, 7 to 10 years. However, the vast majority of you who acquire a company will not own the business you acquire for 10 years. That's just statistically how that works. Why? It's again, these businesses are not quite like property. We'll keep using that as an example. With a property with a ton of equity, you can put a new mortgage on it and refinance that out, right? And take some cash out of that. Businesses, you technically can do that, but it's a lot harder and the leverage doesn't work quite as well, especially if the business has grown a lot. Um, your best bet typically is to exit to purely put that bird in the hand, so to speak, and that liquidity in your hand. So most searchers who have done well, that's ultimately what they do because they're dealing with a pretty successful outcome. So no mandatory exit. We do have what's called a put right, which means we can initiate you buying our shares, and typically that right goes into effect once the acquisition debt is paid off. So on an SBA loan, 10 years, that right would go into effect at year 10, unless the loan was paid off earlier. B. Murphy, do we take LP investment into the fund? Of course. Always happy to talk about LP conversations. Feel free to reach out.
Uh,
I think you're posting for someone, but is there a minimum requirement of equity coming from searchers that you require? So the answer to that's yes. If you're trying to buy a $5 million company and you're putting in $10,000, that's not going to work, right? The larger the company, the stronger your balance sheet has to be. And let's take us as investors out of the picture. This is just a lender requirement. Um, Lenders are not interested in buyers buying really large companies where they have no net worth whatsoever. And that's a challenge, right? Um, uh, when you're trying to do this, you kind of have to right size your approach to where you are financially. Peggy talked about kind of self-awareness in this game. It's really important to understand where you are, not just skill set, but financially. And if you're not a good bet, you either need to find a partner who's got a stronger balance sheet, which will help facilitate. And when I say partner, I mean another co-guarantor or someone like that. Um, but assuming you check the bank's boxes and you come to us, on a $5 million transaction, we're probably going to want six to multi six figures of cash coming from you. That's very real skin in the game. And people are like, well, I've got a giant personal guarantee. What is I'm so much at risk. If your, let's say, net worth is $1 million, the difference between you personally guaranteeing a $3 million loan and a $5 million loan to you is zero. You're going bankrupt anyways if that goes sideways, right? You're already underwater on the personal guarantee. And so the linear value of your guarantee is not actually the same. And so we look at skin in the game relative to the size of the company. So the larger would require, so a 5 million, we're probably looking at 100 to 200K from you. If it's a $2 million deal, it's probably too small for us to invest, depending on how the deal's structured. If you're buying it for 2x and it's a million of earnings, then yeah, we can probably support that. But we're typically looking, 6, 800K, ideally a million of earnings on the low end for the company. And so most of the time, these are deals that are going to be 3, 4, 5 million. So generally 100K, 75K. Again, unique circumstances can apply. So it's not a hard and fast, but that's kind of the minimum there. General feeling about buyers leveraging the ROBS program for their equity injection. That's a great question, Philip. I have a pretty negative opinion of people using ROBS. When you're signing a personal guarantee, and for what people don't know, so ROBS is a program where you can take your retirement assets, so in the US, your 401k or an IRA, and use that capital to invest in a deal and get an SBA loan and social capital that way. Your retirement assets are one of the explicitly excluded assets that are protected during a bankruptcy filing. So, in the situation something goes sideways, if you've used the ROBS program to fund it, you've just sacrificed and lost your retirement assets because those are already in the business. I'm not a big fan of people sacrificing all of that. You've taken years to build that. The cost to that is incredibly punitive. And so I would not be a big fan. People who do it can find success, but you get chained in. There's an administrative cost that applies to those. And there's a lot of other restrictions around it, but I would not recommend it. That's just my opinion, though.
Thanks for
Let's
that. We've got a
see.
couple more minutes, so maybe one or two more questions. If anyone's kind of sitting there with one. Otherwise,
There's one other question I think we missed. Buyers today are in between a rock and a hard place, high multiples, sellers market, debt servicing, what bank needs for service ratios, thin cash if self-funded. The reality is that is the case, predominantly if you're looking on market because everyone's kind of chasing the same thing. So look where others are not. That's a great way to get around some of that. So start figuring out your investment thesis and exploring off-market opportunities. The other is if you are kind of in that situation, I go back to my prior statement. Is it better to own 50, 60, 70% of something that's more likely to be successful than not? So if it is a justifiable purchase price for the industry or otherwise, raise more capital. And I say that, ignore the bias that we clearly represent as investors. But an adjacent question would be one I get asked quite a bit of someone who's acquired a ton for myself and then ultimately invest is if I could go back and go down this path again, would I do it the same way I've done? And the answer is no. I would not have built my holdco the way I built it. Um, if I were to start today and I were to go buy a company, I would be targeting owning 50% of my company from the beginning. And I would raise as much capital as I could in equity above and beyond. And the reason I would do that is you can't miss on your first one, right? Once you go bankrupt on an SBA loan, you can never get any government-backed debt in the United States ever again. Mortgages, business loans, any of those things you have no access to. Um, and so because of that, I'm also then thinking about growth. If I could go get an SBA loan for 70%, I could go get a seller note for 20%, and ideally it's contingent on performance, meaning it qualifies for the SBA and they have to hit a certain mark. That means 10% of equity, but if I raise another 15 to 20% above that, and I put that on my balance sheet, on a $5 million deal, an extra 20%, it's $1 million of cash on the balance sheet above normal working capital. Well, if I can deploy that in the next 12 to 18 months and go get, sounds high, but it's doable with small business, a 20, 30, 40% return on equity for that cash, then all of a sudden I've added a few hundred grand a year to my earnings. And that few hundred grand at an entry price of 4x, again, I'm already $1 million to the plus of value, and my cash flow is higher, which de-risk. But then I'm snowballing that cash flow. So the original free cash flow from the purchase plus this growth cash flow just then gets snowballed into reinvesting into the business. That's a much more accelerated way to getting an exit faster at a larger amount, at which case I would then benefit very directly. And so for me, that would be the path I would go is really focusing on setting the business up for future growth and success, knowing that time is money. If it takes me in your normal acquisition where you're effectively 90% levered, 80% SBA, 10% seller note, your free cash flow is roughly 20, between 20 and 30% of the original earnings of the business, between taxes and debt, right? So in $1 million business, you're only going to generate maybe a quarter million of cash flow. Well, if the seller who didn't have debt was making 1 million a year and you're making a quarter million, that means you need 4 years without growth to generate the same cash flow they would in 1 year. So if you're going to invest in growth, it takes so long to get there. But if I put 4 years of new cash flow already on the books, then I can start accelerating what that looks like. And I can go from a quarter million to a 500,000 and more of actual cash flow and drive that value. So that's why the overcapitalization works and why, if I were to go back and do it, how I would think about it. And when you're solving the kind of valuation debt limitations of today's world, it makes that even more important to have that equity available.
Fantastic. So many nuggets today. That was awesome, guys. Everyone, thanks for joining us. We're 2 minutes out, so we're gonna cap it from questions from here. Adam, Peggy, what's the best way for people to reach you?
Yeah, I'll just I don't know if this gets sent out or how it goes, but you can find us on LinkedIn, certainly. Uh,
Yeah.
I'll just post my LinkedIn there in the chat if you want to click. Peggy's put
I
her
just
email
put my
in.
email. Yeah, I put my email
Um,
in there so people can just reach out.
yep, happy to chat and talk through what you're working on.
Yep.
Thanks so much, guys. And just a reminder, unfortunately, at this time, these guys don't invest in Canadian deals. So if you are joining us from Canada, we are keeping tabs on other funds that do. Otherwise, if you're south of the border, then go direct to these guys and they'd be happy to chat. Someone asked if you need to be a member to access these guys. The membership is for Village Wealth, which we also put the link for the free trial in the chat. So no worries. These guys, feel free to reach out to them if you've got a deal in hand or want to learn more. So
Yeah,
thank
look forward to
you.
it. And thanks, Liz, so much for having us. And yeah, if anything we can do, we're always happy to help.
Yep.
Fantastic. We'll certainly take you up on your offer to come back, Peggy, and have you in again.
Awesome. Great.
All right.
Thank you
All
so
right,
much
thanks,
for
guys.
Have
Appreciate
a
it.
great weekend, everybody. Take
Thank
care.
you.